Okay, welcome to my YouTube channel where every Wednesday I update the market, give you an idea of what's going on. Okay, first of all, let's start out with the market, where it has been and where it is going, okay? And we're going to do that right now. Okay, so the stock market has been in a total, just again, just such a narrow range, and you can see it. Here's 3 different months, and you can see at the end of the day, we try to break out a little bit. We started to go a little bit higher here, see it? And then she's starting to fail here. See, she's starting to pull back. But what's happening is that the market is being driven, okay, by the election. So they're throwing everything at the stock market to hold it in place. And we have a real major problem with the market, and it's going to give us a major stock market crash. But it probably won't be until after the election, because they're doing everything to make sure the market stays stagnant and has very little volatility. And it doesn't have much volatility at all during the day. So again, we're in a sideways consolidation that we're tied to right here. And actually, it's worse than that. It's a very narrow, much narrower. Let's get rid of those. There you go, right here. We're in this narrow consolidation right there. We're about a 1%, 1.5% range, really, every day. So what we have to do is, and why are we in this range? As I said, they're holding the market. They don't want anything to happen because they don't want any pullbacks. So remember what happens with stock markets. When markets go up like this, they normally, in a normal market, they pull back 5, 8, 10%. They go up and they pull back another 5, 8, or 10%. Those are good because they're called pullbacks. The job is a correction. They're to correct all the stocks that are overpriced. For example, right now we have a PE ratio in our S&P 500 stocks of 16. That's insane because we don't have the support. What's that mean? Our earnings growth is decelerating, okay? For the last 3 quarters, our earnings growth have been negative. So every quarter, we're either down 2.1% or down 4% or down 3% or negative every quarter. So let's say we're averaging about 2.8% negative. How can you have earnings going down? Think of it as profits decelerating, but the stock market accelerating. That's called a bubble. Now, that means stocks are extremely overvalued. What has happened here and why we're in such a narrow range is because we have buyers on strike. Money is pulling out of the market like we've never seen before. Money is going away from the market because again, the big funds, the big managers, the banks, the hedge funds, the pension funds, the 401ks, they're not putting money into the market because they know the market's overbought. But they also know you can't support a high price of 16 PE, okay, when you got the sales, top line sales or profits going down. Now, in earnings, okay, a PE ratio tells investors, you and me, how much they will pay per share for $1 of earnings. So if a company's PE ratio is, let's say, 15, that generally means investors are willing to pay $15 for every $1 of earnings. If a company is reporting earnings per share of $2 and a stock is selling for 20, then you simply divide the 20 per share by 2. That means your earnings per share is a PE of 10. The stocks, okay, the stock market has risen 126%. Imagine that. 126% while profits are going down. So, and if you take a look just from October of 2011, Okay, the market has gone up from October 2011 to where we are now. Okay, 82%. Okay, so if you take October, this area here, we'll say right in here, okay, we've gone up over 80%. Okay, now this is crazy. This is crazy. So what we've got here is, and while remember, at the same time, the earnings growth are declining each quarter. In other words, the price of stocks have risen dramatically while earnings have fallen dramatically. So the S&P, the PE of 16 is out of whack. And with the weak economic growth that we're having of less 2%, that makes it extremely overvalued. And especially when the Fed keeps pushing this interest rates near zero, okay, to give investors little choice but to push the money into the stock market. When you're offering money almost at zero interest, where else can you go and borrow money at that price and put it into the stock market? That's what keeps pushing it up. But the reason it stopped going up, it's not going up right now, is as I say, the big buyers are on strike. That's why it hasn't gone up. They're on strike. They're taking their money, not all of it out, but a lot of it out. So where is this all going to end up? We're going to end up coming back right to this peak right here. The same peak we had right here. That's the support. We're going to come right back to here. And if we started to break today, and let me give you a number, let's say, let's give you, we'll get a, let's say 215, okay, to let's say 148, okay, that's a 31% crash right here, 31% correction, okay, and that is going to happen so easy, so slick. But is it going to happen between now and October? It could, but if it does, they'll correct it immediately by doing QE, doing another quantitative easing to make sure all the Saudis and Chinese and everybody else goes into the stock market. And they do that. Remember, I told you over and over, when they print their money, okay, and they print their money, they take that money and they go over and they buy bonds. And when they buy the 10-year treasury or the bond market, then the yields drop or the interest rates, so they're unattractive, pushing all the big boys into the stock market to keep it running up. But a lot of that bond money, that's not happening right now. In fact, we've done so much of this. Did you know what we've done? The balance sheet for the Federal Reserve, when they started out in 2000, right down here, the balance sheet, the printing of money they had on their balance sheet, it was 900 billion right here, okay, and 900 billion. You know what it is today? I think it's 4.2 trillion, okay? So 4.2 trillion, all right? So wow, that's on their balance sheet. So they've got a real problem, okay? And until they start unloading all of the bad treasuries, they bought all the treasuries, all the bonds, all the treasuries from all the banks, and they bought all their bad deals and all their bad subprime loans. That's why they have such a massive debt on their balance sheet. So they've got a real problem. They can't drop these interest rates. They got to keep these interest rates at zero, okay, because we can't afford an increase on our $225 billion in interest every year on our $20 trillion debt. That's what it costs us. About 20, and that 20 trillion, we pay about 225 billion a year. A 1% increase would pop this up to another 100, so that we would then have a $325 billion interest payment at the end of the year. So they're not going to raise interest rates by 1 point, not even a quarter point. And the reason they can't do that is because we're not growing. Remember, our earnings growth, okay, is negative, okay, on average of, we'll say an average negative growth of 2%. Our GDP growth, yet not negative, but still pathetic at 1 point, let's say 6% for the year. We're going to come to 1.6%. So our economy is not growing. our earnings aren't growing, so the economy can't grow. When your earnings don't grow, okay, you can't grow the economy, because when the earnings don't grow, that means you can't give higher wages out, hire more people. So this is a mess, and she doesn't know what to do to get out of this, and that's why we need a correction, okay, and we will get the correction. The possibility of this going up, continue going up, it's nearly impossible. The only way it would go up is with another quantitative easing, but even then, I don't think it's going to do well. And let me show you why, and I'll finish with this. Because if you look back here, you'll see when we started out originally, okay, in 2008 with QE1, we put in $1 trillion in the stock market to move at 80%. We then put in QE2, another 650 billion, but we didn't go up much, just 33%. Then it gets worse. Our next QE, or they call the twist, we put another 400 billion in, but we went up 28%. And the last trillion we put in was 25% we went up. So you see what's going on? 80, 33, 28, 25. So how much more will this market go up if we do another QE? Okay, to front load the market again. No one knows, okay? But the problem is, as the earnings keep getting worse, profits keep going down, or earnings growth keeps going down, and you keep pushing the stock market up, the bubble gets bigger and more dangerous, you see? And that's why everybody should get ready for a market crash, or at least have the tools to know that when the market is going to crash. And that best tool is our color-coded chart right here. Okay, so even if you're in a 401k, okay, just keep up your SPY, and every time it turns red and you're in a 401k, you know you better be careful that the market could start a crash. Okay, so that's where it stands. I don't see any crash between now and election day. I certainly see after that a hell of a crash. Okay, I still believe there's a great possibility, though, I'm going to backtrack a bit, that something is going to happen here in October. I just got a feeling that something may happen in October, maybe a 10%, 12, 15% correction. It just feels like that's what's coming. Okay, and the last thing, if you're in the stock market, when it gets narrow like this and not much going on, you don't leave the market. You stay in the market, because you got to continue with your education in the market. You can't back away from the market, say, I'll come back in 2-3 months. No, because then you lose your momentum of the market, the swing that you're in, okay? And you're no longer, remember, you got to try to become one with the market. Now, as I say to my gang members, you got to think like this. When you invest, you can't be myopic. You got to think about, I got $10,000 or I got $100,000. I'm going to make 10% on that money in the next year. So if you get some lousy months where the market's not doing well like now, you don't just say, I quit and I leave the market, I'll come back. That's ridiculous, okay? You'll never make money. You'll never make money. You've got to stay focused with the market even during the worst times, okay? Because you become one with that market. And then when something happens, you're ahead of it. You're not behind it. I just wanted to show one last thing. There was a big push today from CNBC to buy this water company, AWK. If you had my MV2, it told you do not buy it. Money's coming out. That's why everybody should own this MV2 color-coded chart. It tells you when to get in and when to get out. See you on the charts.